Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in, take a look, see what people are sharing. If you want to follow me at Financial Square Finance, and if you want to join our community, finding-value.com, that's where I dive deeper into all these topics, subjects, sectors, looking for investment opportunities, sharing my opinions on everything and what I'm seeing in the markets. So, Robert Friedland, major copper discoveries since 1900. Couple of things I want to point out here. As we go through and look at these discoveries in history, you can tell by the size of the circle, that's how big the discovery is. You've got the depth coming down, and then you've got your discovery year. In the beginning, we were finding all of these large deposits up towards the surface, which is at zero. So boom, 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 all these large deposits. Now, as we're going through and you go towards 2000, which is 20, almost 25 years ago. It is 25 years ago. These deposits are getting smaller and deeper, which is a problem. The problem is you have to spend a lot more energy to get these out. On top of it, they're lower ore grades, which means you have to move more earth to get less ore. So you move more to get less. And they're smaller, so you can't put and dump a bunch of money into the mine and get a whole bunch back in a certain location. So as they're scattered around the world, these smaller area, smaller little deposits, it costs more to extract them because your economies of scale isn't as big, like these big boys all back here. So these are way easier to get. They expend way less energy. The majority of these are incredibly high ore grade concentrations, which means you get a lot more copper per pound or kilogram or ton moved of earth. And here it's the exact opposite. So when I look at this and I see this, people in their mind say, oh, copper is going to be a good investment. I see this and I say, copper prices are going to go way up. Yes. But we're going to need way more energy to get this out of the earth here. And this is going to be a big difference too, because it's a smaller deposit with lower ore grades and it's deeper. It's like the trifecta there in a negative way. So I look at this and I just say we need way more digging equipment. We probably need a lot more energy. So I just think I see everything in energy terms, and this just looks like a ton of energy. Like we need to expend way more energy to get all this stuff out. So my investment, my copper investment is through energy. That's kind of the way that I view it. Dividend Growth Investor says the stock market is the only market where things go on sale and all the customers run out of the store. Says Cullen Roach. The true contrarian waits for things to cool down and buys stocks that nobody cares about. Yeah, we definitely have that going on right now. The bigger question is, do we go down further? Do we have more ahead of us where we sell off even more? And that very well could be the case. So who here? This is the interesting part. Crude inventory draws that are occurring right now during build season, the EIA. And here's our drawdown here that we've got going on. This is supposed to be building, not drawing. So we have really low inventory levels for commercial inventory. We have low strategic petroleum reserves around the world. Our entire inventory levels are low across the board for oil. And I think we're stuck with people seeing a potential slowdown that we're probably going through right now. And on top of that, we've got these basic deficits or drawdowns in inventory. So it's an interesting dynamic. So what people are trying to do is they're balancing the OPEC cuts where you have a little bit more spare capacity versus the commercial inventory levels that are down. So I think that they're not necessarily worried about the inventory drawdowns because we have a little bit of spare capacity in in the world. And then they're seeing, maybe we're going to get a slowdown is probably what they're thinking. Here's Jacob King. It says El Salvador was the only country on earth to adopt Bitcoin as legal tender. When they realized no one was using it, they forced its acceptance alongside fiat currency. A year later, usage of Bitcoin has plummeted by minus 99%. The government is now selling off their wallet app following a deal with the IMF. Bitcoin has failed everywhere it's been implemented. Its price is an illusion, detached from real value. It serves no purpose and demand is non-existent. That's what he thinks, and that's probably what my thought is around it. When I went and I looked at it with and would talk about it with other people, I just don't. There was no need for me to buy it. So I'm still in that camp. I still think that Bitcoin just isn't a good option for whatever it is. And the design of it, I think, is suboptimal for using it as a currency and also for a store of value, given the problem of the miners and the subsidies of coins that the miners have. I think there's a problem there in the future, and the fees will be astronomical to transact in Bitcoin. Great charts on global coal production and energy consumption. So record global coal output defies simple narrative about energy transition. So here we are, 1981, and you can see these big cycles coming up and pulling back. It's not a straight line, so it's like we build out or do something. I don't know why this cycles. You can see the cycle up and down here. Right now, we're in an upcycle, and I think we're going to go into a very big upcycle. You can see that we've broken out of the 8.3 resistance line. If you drew a resistance line through here, and we're like breaking out here in 2022 and 2023. We have a lot of stuff coming in the future that's going to be electrical driven. So electricity, like electric vehicles and artificial intelligence, these data centers that they're building around the world. And if they're sucking up natural gas to run them, obviously natural gas is going to be in competition with coal, and coal is going to be in competition with nat gas. And we only have so much capacity of both that we can build out and do it as quickly as we can. So worldwide, I think coal demand is going to continue to just rip. And I'm going to make an assertion here. I was wrong in 2020. What I did in 2020, I had the opportunity to buy some of these coal companies at ridiculously low prices. They were profitable companies. They looked good. They had good technical charts. I charted on YouTube here. I charted some of them with you guys with inverted shoulder head shoulders. They looked fantastic. And I just didn't pull the trigger on it because I thought coal was going to go away. So one thing I learned about coal, at least, is that the world is starved of energy, and I don't think a transition is going to occur. I think we are going to burn absolutely everything we've got, and I've changed my mind on that. I think coal's a great spot to be now, and coal historically has been a very good performer during commodity bull markets. And with everything switching to electricity and EVs and all that stuff, I think coal's going to be insane. Like I think it's going to do very, very well. But here is global coal production in 2023. So China, India, Indonesia, United States is still in the top five, and Australia and Russia, kind of the big producers, or I should say consumers. Is that or producers? Sorry, this is production. South Africa's up there too. This is global primary energy consumption by source. So coal has come down, but that doesn't mean that we've reduced its output. It's just that the other ones have ramped up very quickly. So coal was the leader here. Notice that it had zero competition in the 1800s. Oil and natural gas came later. And I think that's what's basically the mix is coming down because we're ramping up oil and we're ramping up natural gas and some of these other, here's renewables, alternatives out here in the future. Nuclear, not a huge mix there for nuclear. If you were to look at old projections, like German projections and stuff like that, they had oil ramping up dramatically, then falling off, and then they had nuclear basically ramping up massively. Nuclear was going to be the lion's share of, I'll say, energy production. So I still think that's going to be the case. Now, when you invest, the uranium companies and where they're going to make money is so far out in the future, it gets muddy a little bit because you can't really project what those conditions will be in 5, 6, 7, 8, 9, 10 years. Because we might have, rapidly increasing oil prices. Inflation is really high. We have very high interest rates, and it'd be a lot more difficult to make money in that type of environment. So again, we'll see what happens, but this is what it is currently, and this is global primary energy consumption from 1920 to 2023, just to show you how fast this is growing. Big move. Look at the and notice that this is 2020 and 2023, and look at the delta here. So from 2010 to 2020, which is a 10-year time span, this went up a decent amount, but it went up about the same amount here in a shorter time frame on the x-axis here. This is a 3-year versus a 10-year. And here, this is a pretty big gap between 2000 and 2010 as well. As we continue to go up and move at an exponential speed, so notice that this is coming upward like this, and I think it's going to ramp and go up vertical. The problem is, I don't know if we're going to get all this energy to go vertical. I think we're going to hit problems trying to do this, and I think where we're going to hit problems is going to be oil, gas, and I'm not sure about coal, but I think oil and gas is going to have problems out. I'm going to say within 5 to 10 years. Oil's probably going to have problems very soon. Gas will come behind it, and then maybe coal behind that. And if we have problems in any of these, what I mean is we are consuming this at an exponential clip. The problem is we won't know there's a problem until after it occurred, and we think we're going way up, and the reality is it peaks and goes down, and you get this big gap between demand and supply. That gap is where I think the biggest investment opportunity is in the market, because energy, you can use energy to build anything. Artificial intelligence is going to speed this process up. I don't care what it makes, you need energy to basically make it. You need materials and you need energy. You can substitute materials to some degree, but energy is energy, and for the most part, people want the cheapest energy that there is possible. So coal, oil, and gas and nuclear are all very cheap. The issue is if one or two of these things start to roll over, where the production rolls over and you get a demand supply gap, these are in front of everything else. It impacts everything behind it. It is highly inflationary. I think what's coming is that oil is going to get into a squeeze here. Natural gas, we probably still have another 5 years before that becomes a problem. But I think we're going to start getting into problems with potentially our primary energy sources. If that's the case, that occurred in conventional oil in 1970. It occurred in conventional oil for the entire world. So the 1970s was America only. 2000s was the entire world of conventional. We got shale. We were blessed to find shale and get that thing killing, in terms of getting it ripping, pretty good. But the downside is it's also going to have high decline rates. So I think oil is going to have an issue first. Then it will be natural gas, probably around 2030. And we're talking worldwide here. So, and it could even be earlier than that. It could be 2025, 26, 27. Because if oil has a problem, what do you think we're going to do? We're going to put it all on natural gas, and the natural gas will be exploited to its fullest, and we could run into problems quicker. So once the ball gets rolling here, it'll snowball and snowball into other categories. And those other categories that I think they're going to hit is going to be coal and natural gas if oil has a problem. And then eventually we'll go nuclear, but that's probably some years away. Ramesh Damani on portfolio construction and position sizing. He says, if I can find really cheap stocks, I can put 80% of my money into technology. I don't balance my portfolio using some mechanical formula. Typically, one gets most excited when the bear market is ending and the new bull market is commencing. That's when people are disbelieving. The bargains are great. I'm happy to look more during that time. And really, what he's saying is when the bargains are there, that's when you jump on them. That's the same thing that I do. He says, if someone tells me about some stock, I might buy a few thousand shares to follow it, not because I know much about the company, but I trust the judgment of that person. I don't know if I would do that, but don't cut your winners just because you have increased more than a certain percentage of your portfolio. Infosys was 90% of his portfolio once. So yeah, asymmetry is what carries the portfolio. It's actually concentrated in only a few companies that are gigantic winners for most people. Warren Buffett, his winners were only 4% of his picks. So asymmetry is what's carrying all of these guys that I've been basically studying and learning about. They just found a couple companies and rode them for a very long period of time. And they got, between 100 and 1,000 bagger on those few companies, which really transformed the portfolio. He says every year they grew at 70% till 2000 came and the stock went to renminbi 13,000. I think that's what, no, not renminbi. It's whatever the Indian one is, with some crazy market cap. It was a PE of 295. That's what he's got there. So this is Howard Marks. He says, book the bet that no one else will. If everyone likes it, sell. If no one likes it, buy. The bottom line is that it is best to act as a contrarian. And that's where you get your big asymmetry. You buy it when everybody's fearful. It says you must hold contrarian views and be right about them. That's really what makes a great investor. Bullish trend. We've got an oil EIA. We have an inventory draw across all of them if you were to add it up. Crude oil is about minus 1 million barrels. Distillates is a bigger draw at 3.18. And we have small builds in Cushing and a little bit larger build in gasoline. Another Warren Buffett quote, a lot of great fortunes in the world have been made by owning a single wonderful business. If you understand the business and you know what you're doing, you don't need very many of them. And that's really how he made his money. He made it on a few. In fact, it's 4%. So he rode those companies. He's riding them and riding them. He's still riding. So he's never going to sell them. And that's where he made all his money. He didn't sell something after 100%. He's still riding it, and he's up 100,000% on some of his holdings. And that's where the majority of his wealth came from. Bullish trend, considering the differential and the currency, this sell-off is ridiculous. Is there something underneath that we aren't seeing? And I understand the fundamentals of oil and the inventory levels, but is there something that's coming that we just don't know about? Are they going to run a false flag event? Now, the fact that I am bringing that up means that if we see yields drop, like the 2-year, maybe that's what they're going to do. It says every day above $70 West Texas Intermediate is a good day once tax loss selling ends, in his opinion. And then he's got some companies there with base dividends, variable special dividends, and buybacks going on there for all these different Canadian companies. Do you see 1 million as life-changing money? Yes, I do. Um, I think life-changing money is actually less than that. So I think there's a couple of levels of life-changing money. So let's talk about what those levels are real quick. I think having 3 to 6 months emergency savings is life-changing for most people because once you get that cushion, and however big that cushion is, 6 months, 1 year, whatever it is, you don't have to take a job that you don't want. You've got a little bit more options. So I would say that's the first level of life-changing money is not being so desperate where you have to take any and all jobs just because you are living paycheck to paycheck and or are in debt. So I think that's the first level. The second level, I would say, is somewhere after that where you save enough money and you can be at a position and then you can say, you know what, I'm just going to walk. Now, you can have the 6 months or 1 year, in there, but the more money you pile on, let's say you can live on your savings for like 5 to 10 years. I would say that's another life-changing amount because what you've done is you've padded your cushion. You've got a bigger cushion than say 6 months. 6 months, I mean, a lot of things can happen in 6 months. I don't think 6 months is enough, but if you save and you save and you save, you kind of cushion everything. Then it changes you from a psychological perspective. You're not worrying about really anything. So it's like, oh, I lost my job. Nah, no big deal. I've got 10 years worth. I can do it. Or if your job is going to ask you to do something that you disagree with, maybe it's illegal even. You can say, you know what? I'm not going to do it. See ya. You just walk. And then you've got all that cushion in the back of your mind, like, yeah, everything will be all right. If it's only 3 months and you've got a family or something, the cushion just isn't big enough, in my opinion. So it's the degree of cushion that you have. And then there's another one, and it doesn't have anything to do with $1 million. It's your streams of income. So after you gain a certain amount of income and savings, then you start to invest those savings and start acquiring assets. Now it becomes a game of how can I diversify my income streams? Where if you lose a job, if you are working a 9 to 5, you have diversified income streams where it's kind of like, doesn't matter. It's only 10% of my income. And you just pad it and cushion it and pad it and cushion it and do that with time. And then eventually, what occurs is money doesn't matter to you at all if you acquire enough assets because it's like there's a big gap between a good life and a luxurious life. There's a really big gap there. So you could be a multi-millionaire or even tens of millions. And your life really isn't any different than someone who's got a million or two. So there's these different life-changing, we'll call it amounts, but I think it diminishes after you hit a certain amount of money. And then it may go up again later. So there's this gap between a few million and maybe like 100 million or something, where like your life is basically the same. You're still driving cars, you're driving similar cars, you still eat similar food. It's all kind of the same. And then after that, where you hit a certain, another threshold where people make your food, you're eating just ridiculous food that other people have made, like professional chefs. You can travel in helicopters and airplanes by yourself. It's just a whole different world, and that is something that's way on the upper echelon of something that I can't even really relate with. So here's Gary Stone, and this is more of the psychology behind things. So he says his experiments revealed three crucial patterns, and I want to talk about this here. We feel losses 2 times more intensely than equivalent gains. We tend to sell winners too early, too long. We overvalue our own judgments and ignore contradicting evidence. This creates predictable market patterns. During market crashes, these biases amplify each other. The pain of losses triggers panic selling. The fear spreads through social contagion. Analytical thinking gets overwhelmed by emotion. The result is opportunities for those who understand these patterns. You buy when there's fear in the market, and that's what you have to exploit. But here's the most important finding. Success in markets isn't being emotionless. It's about understanding how emotions influence decisions and building systems to manage them. This is where trading psychology becomes crucial. The best traders don't try to predict markets. Instead, they follow systematic approaches, recognize emotional triggers, maintain consistent execution. This insight changed everything about how we view trading success. Now, I'm not a trader. And what I do is I try to take entry. If I don't trade, I can just ride through it. So I can skip over all of this short-term market, call it, and then I can ride through and accumulate assets when people are fearful. That's kind of what I try to do. And then I hold it long enough through what I would consider to be the secular bull market. And I don't get these transactions. I don't mess up. So here's another thing to think about. This is why trading is so difficult. Trading is difficult because you have to make a lot of decisions and they have to be right decisions. And then you have to basically rely on a strategy so you limit your losses and your upside potential, you don't gain as much. If you take the Warren Buffett approach, the Peter Lynch, the Howard Marks, and all the really rich people, what they did is they weren't successful. They were just as bad at picking companies as most of these traders are. But what they did is they ride the great companies for a long time, and the asymmetry is so large, and they do it over many, many market conditions that the symmetry carries the whole portfolio. That's the difference. And the problem with trading is the symmetry. The asymmetry isn't as big. So you can buy, and I'll say you've got too many. The asymmetry is a lot smaller, and you have to make a lot more decisions correctly. If you don't sell, you don't ever have to make a selling decision. And if you buy things that are really, really cheap and you happen to get in a few good companies, your whole portfolio just blows up to the upside. So you're making more decisions in trading. You don't have the symmetry to carry you as much. And that's why we don't see as many rich people as traders. They generally self-implode. And that's another reason I wouldn't trade, is because it is just too difficult from an emotional standpoint. Almost everybody self-implodes. Oren Elbez says, so now rate cuts are bearish for silver as well. From a technical viewpoint, it looks horrible. Silver is broken down from its primary rising trend line and $30 horizontal support and the 200-day moving average. It's as though the chart is telling us that no one needs silver anymore. How does that square the fact that we're in the 4th year of fiscal deficits, that inflation is heating up again, and that the current price is barely above the cost of production for primary conducers? He says it's a clown world. Well, maybe there's something going on. I don't know. Maybe they're going to run a false flag event. I have no idea. And maybe the insiders are dumping it all. So, and maybe they're going to run a false flag event to get silver down, to hold it down for a period of time. Difficult to know. But I can tell you this, I own a whole bunch of it. I own a whole bunch of it, and I'm just going to sit in it. Just sitting in and wait. Sitting in and wait, it'll come. When the rest of the world is fearful, we'll grab all of the opportunities that we can handle and not lose a day of sleep, says Warren Buffett. That's his advantage. That's why he beats you. And then he holds forever. He adopts a longer holding period than everyone else. Here's the SPX. This looks pretty nasty. It says that's one pretty clear SPX chart. The 0.25 rate cut was a given. The market reacted to the Fed's outlook for 2025, shifted sharply hawkish towards fewer rate cuts. Many charts I've been posting, though, shows clearly that inflation was not backing down, e.g. the post below. And this is, DBA agriculture breaking out and moving higher. So we've got this potential slowdown in the SPX and maybe in the NASDAQ. And then we've got this inflation in the backdrop, increasing the long end of the curve. It's kind of weird dynamic compared to other times in history. Yesterday was brutal. I get why Ponzi's are crashing, but dirt cheap commodity stocks, while the Fed admitted that inflation will come back, question mark, I was frustrated. But today I'm in a much better condition. The amount of opportunities in Brazil, energy, value, etc. are endless. That is correct. And what you got to do is just ride through it, guys. Ride through it. Ride, 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 ride. Yeah, I know it sucks. I get it. I feel it too. I don't like seeing my portfolio getting smashed in December. And then some people will say, well, that's why you sell it all. No, that's why people don't get rich, is because you sell good value, because you can't time the market perfectly. That's why people aren't rich, is because their holding periods are too small. They can't take the selling pressure. I couldn't take the selling pressure back when I sold some stuff in 09, 2010, and 2011. And I would have been better off holding all of those companies till 2020. Now, some of that was I was forced out of it, given my company we were purchased and we had to move, and they force liquidated my 401k and moved it into another one where I couldn't recreate the portfolio. I would have been better off quitting and leaving all of that stuff in those companies. What I've learned is that my holding period is too short. And right now, I'm holding stock since 2020. It's been 4 years, almost 5 years, no, about 4 years that I've been holding it. And I'm going to continue to hold. I'm not going to try to time this. And I still think we are in a big commodity bull market. And I think oil's demand supply is going to get all sorts of jacked up here. I think that potentially energy and oil in particular, could be the best investment for the next 10, 20 years, or maybe even longer. So I'm going to just keep riding. And then here's something that's kind of obvious too. It says, so Bitcoin is a derivative of the US dollar backed by, in part, US treasuries. Bitcoin sounds more and more like the exact opposite of what it was intended to do. It went from fighting the system to supporting it. That is really true. It really is. Here's HFI research. He says, at what point do you say, crap, maybe we're just a little off on our modeling? Says JPM Global implied. This is what they think for total oil stocks, but this is what reality is. We continue lower, 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 lower. Grady says, if you think gold and silver are slow at the moment, in spite gold being in a resumed secular bull market, consider gold priced in Turkish lira. Gold price in Turkish lira has risen 3,800% in the last 11 years. It goes slow in the beginning until it goes fast. And this is what I think a lot of people are expecting in gold, Grady included and myself. Says this is a parabolic move. This is no joke. Preparing for what is coming is vital. A parabolic move goes faster and faster upwards. Exponential is what a parabolic move is. Some exponential move, like to the 2 or to the 3 or whatever. I'm not going to go over that one. This is silver. Keep in mind, do not get beat down by the declines or lose interest during them. Understand them. Be ready for them. They will pass. And do not fight the market. Use that energy to improve emotional control. And always, always know the very big picture here. We've got a cup and handle. It's gigantic. It's the mother of all legit looking probable cup and handles. Going up. We don't know where 0.3 is, but it's going to be higher. It's going to take time. It's going to take time. Do not mess this up. I'm here to help you guys out. So that's something that the website, if you guys want to join, you can join. Just in, global markets are plummeting today with 3.2 trillion erased from the stock market valuations. Most everything was red, guys. It was a sell everything event. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Discount coupon code is still active if you'd like to use a discount. And that's all I've got. So we'll catch you next time. This is Finding Value.